Nouriel Roubini, he's one of the most eccentric finance personalities in the world, known for having a reputation for being exceedingly bearish in the economic realm. Roubini has earned himself the title of Dr. Doom or Permabear, but regardless, his latest appearance on Bloomberg TV offers a unique insight into this wild market that currently seems very unstable. To our right is the promised land, a future that looks bright with the Fed slowly pivoting, the supply chain recovering, and earnings maintaining their strong growth. For believers, aka the bulls, the market has already bottomed weeks ago, and from here things only go up. But just like every other story, we have another side, the bears, and this time the bears are looking for blood, a situation that many are calling the worst setup in stock market history. On top of extreme inflation, a shaky housing market, GDP recession, raising rates, and political upheaval, we have growing concerns about a collapse in China and an escalation in Europe. I could spend hours talking about all the screwed up pieces of the market that are endangering stock prices in the near term, but whatever you and I may think, the market at the end of the day is a reflection of everyone's opinion, and right now it seems like things are looking up. After the S&P 500 peaked on January 3rd, it spent the next 6 months in freefall, breaking stock after stock until the index had fallen an incredible 25%, reaching a bottom on June 17th. But following that Friday, the market began its slow grind up. As of the making of this video, it has risen 11% from that bottom and is now down about 15% from the high we reached on January 3rd. But like every other major crash in US history, judging whether it's this or the start of a record-breaking rally is very hard to predict. Based on the bond market and the earnings that came out this week, a lot of finance people are convinced that this was it and the worst of the storm has passed us. Roubini disagrees, and he lays out a few reasons in an incredible interview with CNBC. But before I show you the clip, please take a moment to click that like and subscribe button if you're enjoying the content thus far. Now back to Nouriel.
What is the old world view of this recession, this slowdown that we're in, where maybe it's a mega threat, as your new book is called? This new world, it's all going to be fine, is off the mark.
Well, now the consensus view is becoming that hard landing is likely as opposed to a soft landing. But now people say, well, be short, shallow, mild, plain vanilla, garden variety. I beg to disagree. I think there are many reasons why we're going to have a severe recession and a severe debt and financial crisis. Debt ratios are at historically high, 420% of GDP in advanced economies and rising. Lots of zombie corporation, household, government, financial institutions were bailed out during COVID. This time around, we're tightening monetary policy. During the 70s, we had stagflation, but debt ratios were low. After the GFC, we had a debt crisis, but the inflation was falling, deflation, because there was a demand shock and you had a credit crunch. This time we have stagflationary negative aggregate supply shocks,
right,
and debt ratios that are historically high. And in previous recession, like the last two, with massive monetary and fiscal easing, this time around we're going to go in recession by tightening monetary policy with no fiscal space. So the idea this is going to be short and shallow, it's totally delusional.
You see, Roubini is skeptical that the Fed can pull off something called a soft landing. We know they have begun to raise rates, and in the past, that typically means that economic pain is going to be felt by Americans. Very few times has the Fed been able to tighten without the unemployment rate going up. So far, however, despite GDP falling and stocks collapsing by over 25%, the unemployment rate remains unchanged. Surprisingly, it has been falling since January and now finds itself at 3.6%, which is one of the lowest readings in history. While controversial, it's also why the White House is claiming this really isn't a recession, despite the fact that we've had 2 consecutive quarters of GDP contraction, a wild statement to make publicly nonetheless. Now, Nouriel believes that the hard landing we are going to experience, this recession we are already in, is going to be much worse than what they're saying. One of the things he cites is the incredibly high debt to GDP levels in advanced economies. This just means countries are printing and borrowing much more money than they're taking in. This incredible IMF article outlines exactly that, showcasing the sharp rise in debt levels following the pandemic. In 2020, the worldwide debt to GDP percentage got up to 256%, and we jumped nearly 30% in just 1 year, completing an extreme shock to the worldwide financial system. This means central banks went a bit overboard with the stimulus, and now we're seeing the consequences play out in terms of inflation. To battle that, Powell and others throughout the world are tightening, which means we are going into a recession as interest rates are rising and debt levels are at record highs. It's an unfortunate reality as the stagflation narrative takes over. What Nouriel is describing here is everyone's worst nightmare, the economic perfect storm. Basically, the fear is this: the Fed looks at data that is often lagging, which means they're making decisions based on faulty information. For example, right now, it seems like the labor market is extremely good, which to the Fed means they can continue hiking rates. But what if it turns out that the labor market is extremely poor, but the data just doesn't reflect it yet? Now you get into a situation where we're heading into a recession, and unlike 2008, where the Fed can just lower rates and print more, we are stuck with the opposite, a Fed that is pushing rates even higher. And then on top of that, because of the supply chain problems, the demand collapse isn't enough to calm prices, which means you get further inflation in a terrible economy. A double whammy that could result in a complete collapse within the consumer. And who knows what else? When people lose their incomes, the consequences can be extreme. Ray Dalio explains it perfectly in this clip. Take a listen to the legend break down exactly what is happening right now.
Are we close to having stagflation?
Yeah, we are in stagflation.
We are. Stagflation is simply where, you have inflation, and yet at the same time, you have high unemployment.
Yeah, you have economic weakness.
Right.
In other words, you have a stagnant economy. Stagnant, essentially
meaning
means
growth is
low
reduced.
growth,
Right.
low growth, and with high inflation. And that happens through this monetary situation that I'm describing, in which the central bank tries to deal with a middle course. In other words, what does the central bank want? Not too high inflation and not too low growth. And so when there's a lot of debt, because one man's debts are another man's assets, it becomes very difficult balancing act. And that is when you have stagflation, when you produce it. So just like in the 1960s, late 60s, we spent a lot of money on guns and butter, we called it,
Right.
the Vietnam War and social programs and so on. We wrote too many checks relative to the money we had in the bank, which was gold at the time. 1971, the devaluation. Then they print a lot of money into that stagflation. So stagflation is is the middle course when there's two different.
So the Fed and Jay Powell has a balancing act that he has to achieve in order to try to ward off a recession.
Right. So think about it this way. How does he literally fight inflation? Because everybody says tight money policies. And how do you fight inflation? Well, the way that happens is you get people to spend less by taking money and credit away from them.
Right.
So he will reduce the amount of money and credit that's available. The Federal Reserve is going to sell $1.1 trillion of debt that it has, debt assets, bonds.
Right.
And then they're going to raise interest rates. So they create a squeeze that reduces demand at the same time as people don't have enough money because inflation is high. So that squeeze,
And their buying power is less.
that's right, because inflation is high, the buying power is less. And then what that act is to reduce buying power again, to reduce inflation, but it comes at a big cost. And that is stagflation.
So whether you believe in stagflation or a soft landing, I would love to hear your opinion in the comments below. As always, thank you guys for watching. If you enjoyed it, please make sure you hit that like and subscribe button down below.